Hello everyone. So as you probably are aware, many prominent investors and analysts have warned of a coming meltdown in the market for the past year or more. And right now we are at historically high valuations despite having significant real unemployment and high sustained business failures from the COVID shutdown. So this has put the market in a very risky position. And it's kind of like a dam that's at the verge of bursting. It's right at the threshold. And, sure, predicting that it will burst is almost sure to happen, but as to the exact timing of when it does or, what causes it is pretty much anyone's guess. So now it appears a couple of hedge funds are undergoing liquidation, and the stocks of the resulting holdings have tanked. Today I will look into this as well as what my thoughts on whether this could be, the spark that finally sets off this firework, so stay tuned. Hello everybody, welcome back to The Contrarian. For those of you who are new here, my name is Logan. I really like to talk about overall success in investing as well as going against the crowd. If you can go against the crowd, you can outperform the market is kind of the bottom line of my channel. So if you like these kinds of topics, just consider subscribing, and also make a disclaimer that this is not to be taken as financial advice. This is just me talking about something very interesting that has developed recently. So to begin with, you might ask the question of why would hedge funds be liquidating at all in the first place? And it likely essentially has to do with margin and the tendency of hedge funds to take on more risk than they should be. Essentially, margin is when you take out a loan in order to purchase more assets, so you might be able to purchase twice as many assets as you normally would. In this case, it'd be stocks or financial derivatives for these hedge funds. And on the way up, when your positions are going up, it really has the potential to double or even triple or quadruple your returns. So they really help on the way up. And with relatively low interest rates right now, with you're paying relatively little for the money that you are borrowing, and your reward in some cases is much higher than the borrowing rate. But let's ask the question of what happens if your positions go down, they don't go the way that you think they would, and all of a sudden it goes the other way. And this is the situation these hedge funds are likely facing right now, and that is what is called a margin call. Essentially, your lender takes the priority over you in order to be repaid all of their initial loan as well as their loan payments. So essentially, if your assets continue to go underwater, you'll be forced to either add more liquidity, so either borrow more money from other banks in this situation of a hedge fund, or to sell stocks at a loss in order to repay your margin. So I just found an article about this today, and apparently Credit Suisse and Nomura said on Monday that they could take big hits from their exposure to a U.S. hedge fund. So these are the lenders. So it appears even the lenders are not going to get back everything that they loaned out to these hedge funds. And the fund is reported to be Archegos Capital Management, and it's triggered $20 billion worth of selling on Friday. And Friday was actually a positive day in the market, but earlier in the day is likely when the selling took place because the markets did go down a little bit earlier on Friday before rallying. So yeah, two major banks have said they could face big losses from their exposure to a hedge fund, leaving traders and investors wondering what happens next. Among the banks hit by the wave of selling was Credit Suisse, which said on Monday that it and other unnamed lenders were selling positions related to the fund. Traders were guessing about who was exposed ahead of the U.S. market open. And as you'll see, these positions that they had to sell have, the stocks behind them have gone down significantly in some cases. Morgan Stanley and Goldman Sachs, which acted as lenders to Archegos and processed some of its trades, forced the fund to sell shares to cover potential losses after the price of Viacom started to tumble, the Financial Times reported on Sunday. The sales wiped about $35 billion of market value from certain companies on Friday. So looking at some of these stocks that they are referring to that have been impacted, many of them have had significant losses. I would say most of them are Chinese stocks, and they've, predominantly gone down more than what would be typically observed. So in the case of Viacom, over 50% in just several days. So the main question remaining is, will this initial margin call and liquidation lead to other hedge funds going under? So in other words, will the crash of these stocks also make other hedge funds, who were near their margin, will it make them also to begin have to selling stocks, and then this leads to a, kind of cascading effect and then a complete market-wide collapse. And that's certainly possible to happen, in my opinion. After all, it was a very similar situation in 2008 that finally caused the broader market indexes to collapse. But it took several months before it got to that point. But in this case, in my opinion, we'll likely know sooner if this has a ripple effect out to other hedge funds. So if it does cause other hedge funds to be issued margin calls, and then this leads to forced selling in larger stocks, say of an Apple or Amazon or Facebook, then we could soon begin to see the broader market indices collapsing. And the real problem with that right now is that we are near all of the money that can be invested into the market already being in the market. So in other words, there aren't that many people sitting out on the sidelines right now who would be able to step in and buy at a discount. So if this is kind of the final trigger, and then all of these hedge funds go under, it could be a significant collapse that occurs. So we'll probably know, in my opinion, in the next few days and weeks, whether or not this is a long-term trend that does finally crash this bubble. It's just too early to say yet whether this concentrated collapse, it's concentrated right now in just a few hedge funds and a few stocks, but it's a little too early, in my opinion, to say whether it spreads out to the rest of the market. But kind of like in 2008, the Federal Reserve came out, reassuring, saying that this is a contained collapse. It's not going to spread, and of course, it could be said that they're very optimistic, and oftentimes too optimistic. But that is what they said back in 2008, and we definitely saw how that went back then. So bottom line is we are already in a very risky situation right now. Pretty much anything out of the ordinary, kind of like this hedge fund situation right now, could end up collapsing the market. So that's just for you to know. This is not financial advice, but it's rather information for you to take and make your own decisions with. So I hope you guys enjoyed this video. If you like it, give it a thumbs up. If you didn't like it, give it a thumbs down. Let me know why down in the comments, and I hope to see you again.